Halting the damage that fossil fuels are causing to our climate is high up the agenda for politicians, industry leaders, and institutional investors. Yeah, cutting the level of harmful gas emissions is only one part of the story when it comes to stopping global temperatures from rising to dangerous levels. Indeed, the science tells us that carbon emitted from burning fossil fuels can linger in the air above us for 1,000 years. Now, I don't know if that's true, but sometimes you've got to trust the science. And if that is true, and they're not rising off into space as they're supposed to, that's quite concerning. So cutting emissions is only one part of the problem. We also have to remove it and capture it and store it. Trees are nature's way of doing that, but deforestation is rising, and I just wonder whether or not they're being replanted at the same rate. So investors need to look at more man-made methods. So let's find out what's happening with our final panel discussion today, which is called Capturing Carbon. And we have our new panel here. So I think it's, as always, a good point if the guys introduce themselves. Lauren, can we start with you?
Good morning, Mark. So I'm Lauren Wilkinson, Senior Policy Researcher at the Pensions Policy Institute. And I was also the lead researcher on our recent Engaging with ESG series, which covered climate change and other ESG risks.
Thank you very much. Thank you. And Giles.
Yeah, good morning, everyone. My name's Giles Gunesekera, and I'm the CEO of Global Impact Initiative. We're focused on impact investing, and we operate under 5 key pillars of gender equality, Indigenous communities, health, affordable housing, and climate.
Great, thank you. Good to have you with us. Jose?
Hi, Mark. Hi, everyone. My name is Jose Lazuen, and I work for IIGCC, which is Institutional Investors Group on Climate Change. We are the largest European membership for investor collaboration on climate change, and I work for the IIGCC corporate program, which deals with the engagements with the companies within the Climate Action 100 Plus initiative.
Bruce, thank you very much. Thank you. And finally, Freddie.
Hi, good morning, everyone. So I'm Freddie Woolfe. I am an equities analyst at Jupiter Asset Management on our Global Sustainable Equity Strategy, which is a Paris Agreement and Sustainable Development Goals aligned, liquid and diversified strategy that invests in high quality companies that are leading the transition to a more sustainable world. And in the context of the previous presentation around impact, risk and return, the strategy targets outperformance of a mainstream market benchmark.
Great. Thank you very much, Freddie. Thank you, guys. Giles, could you kick us off? Is the transition to a low carbon environment just about investing in new wind farms and solar power farms?
No, definitely not. So I'm speaking to you from Australia, where we have an abundance of land, water and sunshine. From a battery perspective, we're starting to see the more local manufacturing of batteries here in Australia. Positioning them closer to the grid, and then also positioning them in rural and regional areas where they can provide an important source of employment and training, and particularly in replacing jobs in the fossil fuel industry. We've got wave technology. There's a variety of different interesting wave technology which helps that transition to a low carbon economy. A number of them still needing to get to scale, but a wide variety of those that we're seeing, both not just in Australia, but globally. Climate technology is obviously a very broad field, which is all about decarbonising, vertical farming, carbon capture, which we'll talk about later, I'm sure. Here in Australia, as well as in other parts, but certainly in the work that we're doing, working with Indigenous communities and capturing. And capturing the knowledge of that our Indigenous people have of 60,000 years living on country, living on the land, living off the land, living with the land, and the variety of different techniques that Indigenous communities utilise to preserve the land and to decarbonise. We've seen a lot of movements towards using soil as a way of capturing carbon, particularly in a large agricultural economy like Australia. That's extremely important, as it is in other parts of the world. And then finally, the ocean. The frustrating thing I think about a lot of the discussion is that we are focused on on obviously reducing carbon, which is important, but we're very much focused on we're not focused on the largest part of the Earth's surface, which is water. And we know that through using the oceans better and using oceans to capture carbon through a variety of different techniques that you can utilize, it can be a great trap for carbon and a great way of decarbonising. So that's just a few examples, in addition to wind and solar, but certainly some other examples there, and particularly ocean, which I think is not often spoken about, but certainly needs to be commercialised and scaled.
Thank you very much, Giles. Thank you. Freddie, aside from cleaner sources of energy, what's needed to ease the world into a transition to a low carbon economy?
So yeah, I mean, there are sort of two sides of the energy coin. There's the energy mix, and Giles has talked about some really interesting things there. And then there's energy efficiency, and I think we have to look at them both in combination. Renewables need to be something like 2/3 of the total energy source by 2050, according to the IEA's net zero scenario. So clearly they're going to play a hugely important role. But the same report also highlights that energy demand in 2050 will be 8% lower than we have at the moment, serving an economy more than 2 times as large. And so I think those companies that are able to help others to decarbonise by becoming more efficient in their own operations are going to play a hugely important role in the low carbon transition. And in the strategy, we have some companies that help some of the hardest to decarbonise sectors do exactly that. As well as some of the fastest decarbonising companies in their own operations, including by being large buyers of renewable power. Clearly, outside of energy use, there are some big operational improvements in agricultural, industrial, and waste practices to halt emissions as well. And I mean, there are evidently opportunities to use carbon removal solutions where emissions are otherwise impossible to reduce, and I think that's a really important focus. And maybe we'll talk more about that. Behaviour change is also massively important. That something like 2/3 of total emissions reductions need to involve behaviour change, be it in switching to zero deforestation products, taking more trains and fewer planes, recycling more to stop the need for virgin high carbon materials, and companies can clearly help with this by offering businesses and consumers formulations and technologies that reduce the carbon embedded in the product and its use and help to close that loop. And again, there are some fantastic companies, that are having significant impact here and that we can invest in today. And lastly, I think on your point about easing the transition, because this is not easy. We need a positive policy environment, not just on carbon pricing, covering a wide range of economic activities, but I think policy and industrial strategies to provide incentives and investments into those technologies that are going to bring around real world decarbonisation. So I think a key and interesting message here is that from an asset allocation perspective, it's possible to align with delivering the low carbon transition, both at the energy and technology stage, but also at the kind of efficiency, operational behaviour change stages, which opens up a wider and more diverse investable universe. And so for an asset owner looking to align with a low carbon world, both approaches can complement each other at different stages of the value chain.
Thank you very much, Freddie. Thank you very much. Lauren, what else should the investors be supporting if they want to get to a net zero economy?
So quite a few of the things I was going to pick up on, Freddie and Giles already have, which is great to hear that there's so much consensus going on in this area. But if I could just pick up on a few of the key points. So I think cleaner energy sources are a really important component of transitioning to a low carbon economy, but this definitely goes beyond wind farms and solar energy. So if we look at kind of the innovation of more renewable fuels, for example, biofuels, previously linked with rising food prices, deforestation and conflict over land, now there's a new generation of biofuels that can be made from inedible crops, agricultural waste and oils. And then moving on to kind of the reduction of waste, this is really important. Cutting demand for energy while keeping raw materials in use for longer is likely to really move this forward in a way that just looking for new energy sources won't necessarily be able to succeed in. And I think it's also really important to recognise that even after huge efforts have been made to move to a low carbon economy, there will still be some sectors and areas where it's just not feasible for them to be net zero from the perspective of either technology or costs. So it's really important that there's the development alongside this of carbon capture methods. So improving soil management techniques, protecting natural carbon sinks such as wetlands, and restoring damaged habitats so that we can balance off against those industries where carbon production is really quite unavoidable.
Thank you, Lauren. Thank you. Jose, institutional investors are quite influential with a huge pots of capital that they control. Do you think they're aware of the importance and need to actually remove the carbon above our heads if they want to protect the climate?
Yes, I think that the short answer of this is, of course, yes. I think that most institutional investors are well aware of this, because when you look at IPCC scenarios, whether it's the P1, P2, P3, these are scenarios for policymakers, you really see that there is a role for carbon removals. This can be a small 5% or 40%, even the IIA net zero scenario. So I think that, of course, institutional investors know that there is a role there for removals. However, what we're seeing is significant challenges for investors to actually identify and invest in these trends. And if I could break down these different challenges for investors, I would say that, first of all, the technology removals are not yet here in terms of technological development. Then the business case is perhaps unclear as well. And the third one would be that there is an unclear investment vehicle as well too that can be scale up. The fourth one would be the real challenges with the reputational problems of some of the markets that are selling these carbon credits. And the last one is the allocation of responsibility. So actually, if the companies where investors have invested are already offsetting or doing these removals, what's the responsibility for investors, right? In terms of the challenges of double counting, etc. But if I can focus on just two of these, I would say that the business case is unclear because to capture carbon is not always rewarded unless you are in a compliance market where there's a price on CO2, or perhaps because some sectors like the oil and gas sector can actually use this captured CO2. And then it really depends on the sector, whether it's power, steel, etc., where there is like an actual return on the investments, etc. And then the need for the fact that there is no clear investment vehicle, I think that's very important as well, because either investors can invest through the companies directly, and they can engage with them, so they can invest in these carbon removals, etc. They can do it through bonds with the specific covenants there, through project finance, through perhaps accessing the offsetting markets. But in summary, I would say that it's still unclear for institutional investors where to invest, when, and perhaps why. But I think that overall, we are still in a phase in which institutional investors are pretty much focusing on trying to engage with companies to follow the mitigation hierarchy, which is first really reduce to the maximum possible the internal emissions, like the value chain emissions, and then they can move on to removals and to compensation as an addition as well.
Thank you very much, Jose. Lauren, are the PPI having to create awareness to investors that fighting against climate change will involve, as we're now calling it, removals?
Yeah, so I think there's still a lot of work to be done in this area. Those who are responsible for making decisions about schemes' investment strategies are increasingly aware of the importance of integrating ESG risks generally into their investment considerations, obviously with the rapid increase in regulation and just how much everyone across government and industry are talking about it. It's really hard for them to ignore. But I think this is quite a high level range of knowledge, and there's a lot more work to be done to build that deeper understanding of the different areas involved. Looking at the way that schemes are talking about the risks in their statements of investment principles, even those who explicitly talk about climate change are doing so at a really high level, often using words taken specifically from the regulations and not really talking about the different aspects of it beyond gas emissions, not really highlighting gas emissions even. So it's, very high level. And I think there's a really strong lean towards leaving it all to external managers and not building that internal expertise. So, there's definitely work to be done to build that understanding among decision makers about aspects beyond just reducing harmful gas emissions. And we found in PPI's Engaging with ESG survey, which we ran last November, only half of respondents said that they were currently considering net zero targets in their decisions about investment strategy. So that really suggests that there are low levels of engagement and knowledge around this area. So I think it's really important that schemes do build that internal expertise so that they can properly hold their external managers to account. I really think the greatest progress in this area isn't going to be made until there's a shared understanding across all those involved in the investment process about the broad range of areas that need to be considered, and not just those high-level climate goals.
Gotcha. Thank you very much, Lauren. Thank you. Freddie, in your experience, are institutional investors actively looking at solutions to do with removal and storage?
Well, I mean, look, in the context of sort of awareness around the need to decarbonise and align with achieving Paris Agreement in portfolios, you only need to look at memberships of bodies like Jose's and Climate Action 100 Plus to show that quite evidently institutional investors are stepping up to the plate and looking to support the low carbon transition. Some of which, for some companies, will probably involve carbon removal. In doing so, however, there is a huge need for investors to understand what companies are doing to decarbonise and challenge how credible those decarbonisation strategies are. So we need to get into the weeds of how companies intend to get there. What is their strategy? See sort of science-based short, medium and long-term targets that are irreversible, ensure that the governance aspects are aligned, and really understand the alignment of CapEx programs as well as the credibility of the technologies that can be used to pursue decarbonisation, to Jose's point. Now, I think in the context of carbon capture, this technology plays a role in, I think, every major low carbon scenario I've seen, but to significantly varying degrees. So the IEA's net zero scenario is a lot less bullish on CCS than many of the IPCC scenarios. And even then, it requires 7.6 billion tonnes of capacity by 2050. We currently have around 40 million. So a hat tip to Tarek Solomon at HSBC for thinking about demonstrating the gap in this way. But even to meet the requirements of a very conservative scenario, we need to build 5 million tonnes of capacity every week until 2050 to reach that goal. That's 1/8 of current capacity every week, which is quite clearly no small ask and is anything but certain. And I think we also need to make sure that the calculations of the benefits of carbon capture take into account the full range of emissions from the process, including the net benefit if it's used for oil extraction, and whether it's actually a reduction of social costs over switching to renewables or other technologies. These are some highly complex calculations, but they clearly need to be done, and the consequences of the outcomes fully understood at a systems level and when thinking about company-specific plans. So clearly carbon capture will play a role, but I think investors need to be very careful about expectations from this kind of technology, particularly when it forms a large part of a company's net zero delivery. Ultimately, we cannot be expecting the kind of high carbon status quo plus capture and offsets to deliver a low carbon world. And we have many decarbonisation options in many sectors that can work today and are continuing to get better, which is why we think it's essential to prioritise real world emissions reductions and only use these technologies in offsetting kind of otherwise impossible to reduce carbon, which should be considered a really high hurdle. And that's particularly important when assessing the credibility of a company's alignment with delivering Paris today, which is a key criteria in our investment process.
Thank you, Freddie. I think you've given us what is known as a reality check, so thank you very much for that. Thank you. Lauren, when it comes to carbon removal, is this something that investors have to be active with, or can they go passive?
So I think there's two sides to investment when we're looking at the shift to a low carbon economy. So on the one hand, passive strategies are perceived to offer good value for money. And when it comes to increasing investment in areas that could aid this transition, so those that are working on innovative solutions to different types of renewable fuels, this could be done successfully through a passive strategy using the appropriate metrics. But I think when it comes to encouraging innovation and progress from companies that are among the biggest carbon producers, or we might want to call them carbon offenders, engagement and stewardship are going to be really important going forward. There are a number of climate action groups calling directly on pension schemes to divest from sectors that might accelerate climate change or challenge the transition to a low carbon economy. And divestment does continue to be a popular approach to mitigating these risks. But I do think that there's a role for engagement and stewardship, as I've said, in terms of delivering longer term progress. So I think it's important to recognise that as long as these companies continue to deliver positive returns, there will be investors for them. There will be a steady supply of investors. And if institutional investors who are more sustainability minded choose to divest from these sectors and companies, then we're likely to have investors buying equities in them who care less about the transition to a low carbon economy. This will lead to poorer progress in the long term. And divestment prevents the scheme or asset manager acting on their behalf from engaging either collectively or unilaterally, which might otherwise improve the company's ESG performance. And I think the other thing to take into account is that some of the companies in sectors that are traditionally high carbon, so ones I was saying were carbon offenders perhaps, are also making substantial investment in work towards a low carbon future. So by divesting from these companies, investors might be withdrawing capital from companies who are actually leading the way on low carbon innovation. So I think an active mandate really does offer more in terms of being able to engage there. But I think that schemes need to take a more active role and, as I said, build that understanding to make sure that they understand the engagement and stewardship activities being undertaken on their behalf by external managers.
Thank you very much, Lauren. Thank you. Jose, what role are voluntary markets playing in removing carbon?
Thanks, Mark. Well, I think that they are playing an important role at the moment, especially for this first tranche of investments, in nature-based solutions, in these incipient, nascent technologies of technology removals. And that's very important, for conservation, for increasing the forests and protecting them. However, what we are seeing at the moment is really a focus on trying to scale up these markets, to try to sell these offsets, to fund these initiatives at the moment, without really looking after some of the very large and persistent challenges that the voluntary markets have faced since the Kyoto Protocol, since very, very long time ago, So there are still challenges. Of course, there are organizations, the Task Force of Voluntary Markets, the BCMI, etc. They are doing a great and complicated job in trying to solve those challenges. But we are really seeing that there are still very problematic issues, particularly on the supply and demand dynamics of the voluntary markets. Because, for example, on the supply side, what we're seeing is that the price of these offsets is extremely low. And that's not reflective of the price of actually removing carbon. And that means that some of those projects, the quality, the integrity of those projects is rather low. And therefore, we have problems of the additionality of these projects, whether on nature-based solutions, whether on actual renewable energy projects, etc. The permanence of those offsets, because as right now we're seeing contracts of 1 to 10 years of the length of the offset contract, when science says that these offsets should remain for 500 years, right? And there are no mechanisms of forcing the purchasers to renew those offsets, so the permanence can actually work. So we're seeing many problems on the supply side. And of course, those problems go back to the demand side, which is, as the offsets are extremely low in the voluntary markets now, that means that some of the companies buying these offsets as well have very low ambition, because they will always choose, or they will in principle choose the lowest cost strategy, right, to try to decarbonize. So I think that there is still a lot of homework to do in the voluntary markets, strong supply guardrails to only allow the best and high quality projects, higher prices to really filter those companies that really want to decarbonize. But as well, demand side guardrails, I think that they're very important to really emphasize that companies can access these markets if they have science-based targets, if they have a transition plan, and we can actually see progress on those plans. Because as of right now, there are plenty of companies, just accessing the voluntary markets. Some of them, of course, with a fantastic goodwill, screening these projects, really trying to make an effort to access the best projects. But then we also have a lot of laggards with no ambition at all, just making very misleading claims as carbon neutral shipments of fossil fuels, etc. So they're important. They're very important to preserve nature, to really fund this first part of these technology offsets and nature conservations. But there is a lot of homework to do, and yeah.
Thank you. Moving into the last 5 minutes now, Giles, I did mention to start there that this is not just about technology. Trees are, of course, nature's way of removing carbon from the atmosphere. How important are deforestation strategies in achieving net zero target?
Oh, extremely important. And if I could just pick up on the points of that Lauren and Freddie made too. I mean, COVID has given us, very few gifts, but one of the gifts has been obviously a reduction in carbon, and particularly through reduction in travel. We need to utilize that. And obviously, while there are some challenges around carbon capture, I'm of the belief, and we're starting to see it on a daily basis, that there will be commercial, scalable solutions there, because that is, one of the big challenges, but also one of the greatest opportunities is actually capturing carbon in some of our affordable housing projects that we're doing. Not only are we looking at the building process and ensuring that that's sustainable, but also there's technology around where, the bricks and the cement is actually capturing the carbon. So you can put up affordable housing buildings and complexes that are moving people out of slums into affordable housing, and the housing is actually acting as a carbon sink. So the technology is there, just needs to be scaled and utilised more broadly. But to your specific question, targets haven't worked, so we need to be more vigilant around it. If we take the Amazon as an example, the world's greatest carbon sink, unfortunately, the farming from both a food and a cattle perspective, it would be much better for the world to pay those farmers not to deforest than it would be, for them to actually, utilise the land for farming, because one, it's not arable for the sort of crops that they're building, but number two, particularly from a cattle perspective, the yield is not there either. So, and where the solution really lies, Mark, is very much in cutting off the finance, as we've seen with other climate solutions. Ensuring that that banks are not lending, or other corporates are not lending to projects that are engaged in deforestation.
Thank you very much. Thank you, Freddie. Are deforestation strategies working?
God, it's a challenging question. I mean, look, clearly deploying nature-based solutions can be a very powerful tool for removing carbon from the atmosphere. And importantly, unlike some others, it is a technology that we have readily available to us today and that we know works, and one that, I think needs to be a priority, although my comments about prioritising real emissions reductions over offsets still stand. I think the scale of the requirement is also absolutely huge. Giles mentioned the Amazon. One company has recently produced a net zero scenario that says that an area the size of Brazil will need to be reforested by the end of the century. And again, reflecting on the kind of feasibility of that's going to be really important, as well as all the kind of quality challenges that Jose mentioned too. And I think we've also been starkly reminded just this year about how vulnerable forests can be when the wildfires in the western US apparently devastated significant acreage in California's offsetting program. What happens to the carbon accounting there? And I had no idea about Jose's point about length of offset projects being 1 to 10 years. That sounds crazy. I do think an area where companies can have a lot of really positive influence on deforestation, those within their supply chains. So much to Giles' point, working with suppliers on more sustainable agricultural practices and to cut out deforestation. And this touched on a whole range of industries with key inputs of timber, palm, soy, cattle, and ultimately companies have the ultimate sanction of kind of product reformulation if they're unable to get the sustainable supply they need. Going back to that earlier point on behaviour change, and there are certain companies that are doing fantastic work in this area, and that includes their supply chains in their net zero strategy. So personally, I think this is an area that should definitely be prioritised, as the benefits of one company engaging on this can clearly be multiplicative across the supplier's wider client base and actually across the whole industry.
Thank you very much, Freddie. Thank you. Good to hear your thoughts. And the final point, Jose, give us some idea how mature the carbon capture technology market is and some of the things you might be seeing.
Yes, so regarding the specific carbon capture technology market, I think that at the moment I would like to say otherwise, but it's really immature. There are a number of issues going on there that we are not seeing real progress, and that's a problem because the IIA net zero scenario is saying that the scale up of CCS needs to grow by 60 times by 2030, and we are not seeing progress close to that. So we are seeing several issues here, not only from the science, but also through the engagements through Climate Action 100+, where we have a work stream called the Global Sector Strategy. So we sit down with many companies of one specific sector, we discuss the challenges, and we try to find actions to remove those challenges and barriers. And we're seeing that CCS, really the economics is not there yet. And this is, of course, depending on the sector. For oil and gas, it works well because they use the captured CO2 to pump more oil and gas out of the earth. So well, that's a bit controversial, of course. But then we see like the power utility sector, where the levelized cost of energy massively increased, plus 50% of the cost. And most of the companies in Europe are already skeptic of using CCS. Why? Because they have renewables as an alternative. And then we have many other challenges related to the actual transport and storage. The energy consumption is quite massive of the CCS devices. But then with all sectors like steel, cement, etc., CCS is quite a powerful tool for them. Why? Because they don't have the alternative like the power industry with renewables. But just to give like the big picture of why CCS is being invested in, this is put it very simply to actually avoid the risk of stranded assets in heavy industries. That's the sole purpose of CCS today, and this is because in chemicals, in steel, in aluminium, in cement, etc., these plants have plus 40-year life. And of course, it's legitimate that companies don't want those plants to be stranded, particularly in Asia, where some of these plants are particularly young. You know, they were built in the last 10 years. So, as with every technology, I think that at some point this will scale up. There will be progress, but this needs to scale up massively. And one of the sectors who would be one of the largest beneficiaries of this is oil and gas, and so far is investing 1% of the capital expenditures. So perhaps not even them are really believing into this technology either. So it's challenging for the moment, and it's very dependent on policy. So I would say that, you know, we will see progress if there is a massive policy change, because the economics are challenging, and this needs to be subsidized if they really want to make it work. And then a lot of capital expenditures by the incumbents. So I would like to say otherwise, but I think the situation of CCS is still very challenging at the moment.
Yeah, yes, thank you very much for that, Jose. Yeah, it's quite an interesting discussion. It's clear it's a very young, growing market, and needs to be quite big strides made to make a dent in this particular area. And of course, there are other factors as well. It's good that you shouldn't rely on this. So yes, thank you. And that, I'm afraid, we've got time for this particular discussion. So thank you, Jose, Lauren, Freddie, and Giles over there in Australia. Thank you very much, guys. Thank you.